Hi friends, very good evening. Exams are coming nearer and I know your preparations are going full-fledged and this revision session is going to help you a lot. We'll be covering the entire syllabus of CA Final FR. I repeat, yes, entire. All Indias will be covered. Yes, all Indias will be covered. But we'll just stick to the things which are relevant from exam point of view. So this revision is kind of additions to your preparation. You've done it excellently. I know you're doing it and this is just going to help you a bit. Just tell me first of all, are you able to hear me properly? Am I audible, visible properly? I want a reply from all of you. Am I audible, visible properly? Okay, I think yes, the replies are there from your side. Thank you, Aman. Thank you, Shweta. Thank you, Bala. Thank you, Shankar. Thank you, Priyanka. Now, what will be our agenda for this this financial reporting revision will start today. Today we have two sessions, 6:30 to 8, and again we have a 9 to 10:30. So today it's 3-hour session. From tomorrow onwards, we have 4.5-hour session. I repeat, today is 3 hours. From tomorrow onwards, it's 4.5-hour session. Today we have it on YouTube. From tomorrow onwards, it will be on Unacademy app. I repeat, from tomorrow onwards, it will be on Unacademy app. Sir, would it be free? Definitely, it will be free. So this revision sessions are free. On Unacademy app, we have scheduled it under the special class. The link for special class, it's already there on our Telegram channel. If anybody wants the link of that lectures, it's there on our Telegram channel. Go to Telegram, type CA Niket Thacker, you will get our group, you will get our channel. In that, the links of all the lectures are basically there. Now, sir, what will be the coverage in this revision class? We will touch upon all your Indies. I repeat, we will touch upon all your chapters, we'll touch upon all your Indies. Everything will be covered, but only the things which are relevant from exam point of view. We are not going to solve the questions. No, we are not going to solve it, but important questions will be discussed in this revision session. We'll be covering up all the theory and we'll be covering up the important questions whichever are there from exam perspective. Okay, let's begin. Now, sir, flow, we are starting today. We are starting today with introduction to Indies, the basic. Uske baad we'll go to share-based payment and we'll finish up business combination. Today's target is 3 topics: introduction to Indies, share-based payment and your business combination. This is today. Tomorrow, we have 4.5-hour class. In that 4.5-hour class, we'll revise up your entire consolidation. Okay, today business combination will be done. Tomorrow we'll be having consolidation done. Let's begin. Before that, I'll just bring to your notice a new feature which we have introduced at Unacademy. We call it as iconic program. At Unacademy, we're not having physical material and students wanted physical material. So under iconic program, we have a physical material for you all. Second thing what student demanded is, sir, we want to evaluate a test series. The test series should be evaluated. For that, we came out again with iconic program. It has an evaluated test series. The regular test series will be conducted with evaluation given to you. And the third thing, we assign a mentor to you who will push you forward. I know you're doing great job, but just a mentor is assigned to make you push forward so that you come out with your best. What are the features in this iconic program? We have 1:1 live mentoring. We have evaluated test series, printed material. Now, your CA final is actually getting over, but you can definitely recommend Unacademy to all your friends. The subscriptions are really cheap. I'm telling you, the subscriptions are really cheap. It's a win-win situation for all of us. So faculties, they are doing well. The Unacademy is getting a great platform, and yes, you all are also getting a benefit as of now. Use code Yeshas Live, YSHASLIVE, Yeshas Live or Yeshesh, you'll get 10% discount. Group 1, Group 2 plus combo subscription is also available. Okay, let's begin with today's work. Okay. Now, which topics are we doing today? 3 things. 3 things. Introduction to Indies first. Number 2 we are doing is your share-based payment. And number 3 we are doing is business combination. These are the 3 topics to be done today. Tomorrow we'll finish up your entire consolidation. Today, business combination. Okay, let's start. Now there's a question from Mahesh, sir, how many days this revision will be? Okay, we have this revision on 23rd, 24th, 25th. 26, 27 is holiday. 26, 27, I'm out of town, so I'm not taking the class. 28, 29, 30. So total 6 days. Total 6 days. Today is 3 hours, otherwise daily it will be 4.5 hours. So 4.5 hours, the total approximately around 26 hours we are going to do this revision. Yeah, 26 hours will cover up all in days, just the things which are relevant from exam point of view. Okay. Now, sir, where can we find the material which you have kept open? Where can we find the material which you have kept open? If you just see one of the message, the first message in the chat box, I put a link for material, or you can go to our Telegram channel. You will find out the link for material. I've created one Google Drive link where all the materials are uploaded. Complete batch, fast track batch, and this is revision. I have a revision batch word written, and under revision batch, this material which is appearing on the screen, that will be there. In case you don't have this, it's okay. You can keep your materials open. I repeat, in case you don't have this, you can keep your materials open. This is nothing but a discussion. We're trying to cover up all the concepts, whatever we have learned, just to make sure that we are aware about everything. Now, a few things, if it is not known, it will get automatically revised or understood. Okay, let's begin. So this material, if someone wants, it's there in our revision material in the Google Drive link. The link is there on my Telegram channel, plus the link is also there in this chat box at the beginning. At the beginning of the chat box, you'll find a link. Okay, first is Introduction to Ind AS. Introduction to Ind AS. We needed a global accounting standard. See, every country doing accounting has their own ways. The problem is now the companies have started raising the fund world over. So USK companies or USK people are investing in India, like Facebook has invested in Reliance. So now they want to know how the things are in Reliance, not just as per Indian perspective. They want to know that accounts should be comparable world over. So accounts just made as per Indian things, it's not okay. We want accounts which are comparable world over. For that, a global standard was needed. And for that, IFRS came. I repeat, for that, what came up? IFRS. So there's an International Accounting Standard Committee, which is a London-based group. They came out with International Accounting Standard Board, IASB. And IASB came out with your International Financial Reporting Standards. Now, before this IFRS, this actually IASC had came out with IAS, International Accounting Standard. So there were International Accounting Standard, and in 2001 they were kind of restructured. So this IASC was converted into IASB, and IASB developed some further standards which are called IFRS. Okay, so IFRS includes two things. When we call the word IFRS, it includes two things. One, it is IAS, that is International Accounting Standards, which were issued before 2001. And after 2001, they came up with IFRS, they are additional standard. So see, subsequently, IASB has came out with IFRS. And IASB has not rejected your earlier IAS. IAS are also there. Okay. So now the term IFRS includes your IAS issued by IASC. It includes your IFRS which are issued by IASB, and there were interpretations related to both. There are interpretations related to both. Both are there. I repeat again, with IFRS coming, the earlier IAS which were issued, they are not gone. IFRS are the additional standards which were issued. Okay, now IFRS are based on principle. They are more principle based. They give you a guiding principle. You need to apply them based on facts and circumstances. Now, every country has started moving on towards IFRS. So how do you comply with IFRS? How do you become an IFRS compliant? Two ways. One, you adopt IFRS. Second, you come out with your own set of standards which are based on IFRS. That is called convergence. One is you adopt IFRS, or second is you converge to IFRS. Come out with your own standards which are based on IFRS. And India, what has India done? We have adopted or we have converged? We have converged. Yes. So Ind AS, your Ind AS are IFRS converged standard, which are based on IFRS, but we have made bit modification as per Indian scenario. So Ind AS are nothing but IFRS converged standard issued by central government under the supervision and control of Accounting Standard Board of ICI in consultation with NAFRA. So Ind AS are IFRS converged standard. We have not adopted IFRS, we have converged to IFRS. We came out with our standard which are based on IFRS. Okay. Now, I told you IFRS includes IAS which were issued by IASC. There were actually 1 to 41 IAS, IAS 1 to IAS 41 and IFRS 1 to IFRS 16. Now, how is the numbering given in Ind AS? IAS 1 to IAS 41, they are nothing but Ind AS 1 to Ind AS 41. I repeat, IAS 1 to IAS 41, Ind AS 1 to Ind AS 41. IFRS 1 to 16, we call it as Ind AS 101 to 116. IFRS 1 to 16, we call it as Ind AS 101 to 116. Okay, now there's a word called carve in, carve out. What do you mean by the word carve in, carve out? Now, first let's understand the word carve in. Carve in, something which is not there in IFRS, we add it. Something which is not there in IFRS, but it is added in your Ind AS, that's called as carve in. Example, CCBC, Common Control Business Combination. This is something which is not there under Ind AS. Sorry, IFRS. IFRS doesn't talk about CCBC. We have added it. That's carve in. Okay, but sir, what is carve out? Something which is there in IFRS, we changed it. Something which is there in IFRS, we changed it. That's nothing but your carve out. But I tell you one thing. If IFRS has two options, we remove one. If IFRS 2 option, we remove one, we are still following IFRS. That's not carve out. Removal of option is not carve out. But IFRS has a different treatment. We have a different treatment. That's carve out. Example. Okay. Gain on bargain purchase. Gain on bargain purchase under your IFRS goes in P&L, retained earnings. So gain on bargain purchase goes in retained earnings. Here, we take it under capital reserve. If reasons are clear, if reason for gain on bargain purchase clear, first comes in OCI, OCI to capital reserve. If reason for gain on bargain purchase is not clear, it directly goes to capital reserve. So they have it in retained earning, we have in capital reserve. We follow different treatment. That's carve out. Okay, so removal of option does not result into carve out. So carve out is something which we have changed. Carve in is something which we have added. Now, roadmap for implementation. How are the Ind AS applicable? How are the Ind AS applicable? Just a minute. Just a minute. Need to get back to the page. This has gone to the last page. Okay, roadmap to implementation. 1/4/15 onwards, it was voluntary for all the companies. Acha, just remember, this is only for companies. Ind AS is applicable only for companies. Partnership firms, LLP, sole proprietors, they are not required to follow Ind AS. So 1/4/15 onwards, it was kind of voluntary. 1/4/16 onwards, listed, unlisted companies, listed, unlisted both, having a net worth 500 crores or more. So listed, net worth 500 crores or more, unlisted, net worth 500 crores or more, and parent, subsidiary, associate, JV of above. Parent, subsidiary, associate, JV of above. Okay, this is 1/4/16 onwards. What's the scenario today? 1/4/17 onwards. 1/4/17 onwards, all listed or in process of listing, they are covered. Unlisted having a net worth 250 crore or more. Unlisted having a net worth 250 crore or more, plus your parent, subsidiary, associate, JV of above. You are covered. Your parent, your subsidiary, your associate, your JV will be covered. You are covered. So your parent, your subsidiary, your associate, your JV will get covered. Okay. Now, sir, what if I don't fulfill the limits? Then for you, the normal accounting standards are still applicable. Don't think that normal standards are gone. They're still there. Okay, can I have part AS and part Ind AS? No. This Ind AS are applicable to your standalone financial as well as your consolidated financials. And if you're listed in SME exchange, then Ind AS is not applicable. If you're listed on SME exchange, Ind AS are not applicable. And now, whenever you're applying Ind AS, for example, you fall under phase 2. For example, you fall under phase 2. For you, it's mandatory from 1/4/17 onwards, but you have to give 1 year previous information also as per Ind AS. The effective date of transition for you will be 1/4/16. If you fall in phase 2, 1/4/17 hai, but 1 year comparative has to be there as per Ind AS minimum. Effectively, it will be as 1/4/16 only. Okay, now once applicable, Ind AS is applicable lifetime. Yeah, once applicable, it's applicable lifetime. Sir, can I stop following Ind AS? No, it is to be followed lifetime. Sir, if I started voluntarily, still it's applicable lifetime. Sir, earlier I was a subsidiary of a company which follows Ind AS. Okay, company follows Ind AS. Uski subsidiary. So I was a subsidiary. That's why Ind AS was applicable to me. Now I am no longer a subsidiary. There was an Ind AS wala company, I was the subsidiaries, Ind AS was applicable to me. Now I'm no longer a subsidiary. Would still Ind AS be applicable to me? Answer is yes. Once applicable, it's applicable lifetime. Okay. And if you fulfill the criteria, if you fulfill listing or net worth criteria, it is applicable to your parent, your subsidiary, your associate, your JV. Now question, subsidiary is subsidiary. Subsidiary is also your subsidiary. To them also it's applicable. So subsidiaries associate, subsidiaries JV. Okay, if it applies to you, it applies to your subsidiary, your associate, your JV, not your subsidiaries associate JV. So one option is, if at all it applies to you, it applies to your parent, your subsidiary, your associate, your JV. Now question aaya, so subsidiaries associate JV, to them as such it doesn't apply. But suppose if you're a part of one consolidation group, their figures as per AS, your figures as per Ind AS will be a mismatch. So practically they will be following Ind AS. Practically they will be following Ind AS, but as per roadmap it doesn't apply to them. Okay. Now sir, overseas subsidiary, foreign subsidiary. You say Ind AS applies to you, it applies to your subsidiary. Subsidiary is abroad. Subsidiary is abroad. So now pay attention. For their standalone financial statement, they can follow the rules and regulations applicable as per that country's law. They can follow rules and regulations applicable as per that country's law. But for the preparation of CFS, they need to prepare one more set of financial statement which will be based on Ind AS. Sir, if it's a foreign subsidiary, they can follow their law for SFS purpose. But for preparing CFS, I need their financials which will be as per Ind AS. So parent is abroad, foreign parent. Now you say Ind AS, if Ind AS is applicable to you, it applies to your parent, subsidiary, associate, JV. Sir, abroad mein parent hai. Okay, the foreign parent can follow rules and regulation as per their country's law. They don't need to prepare financial statement as per Ind AS. The foreign parent will not be required to follow the things. Okay, this is done. The Ind AS will not apply to such foreign parent. Okay, this was a roadmap for a normal companies other than bank, insurance companies, NBFC. Other than bank, insurance companies, NBFC. Now banks and insurance companies, actually this is postponed. Ind AS ka applicability is postponed. But NBFC ke liye it has been said for NBFCs, phase 1 is starting from 1/4/18 onwards. Phase 2 is 1/4/19. Phase 1 similar. Phase 1 is basically listed, unlisted, net worth 500 crore or more. Phase 2 all listed, unlisted having. Phase 2 mein all listed, unlisted having a net worth 250 crore or more. Okay, one thing, under your NBFC, voluntary adoption is not allowed. Under your NBFC, bank, insurance company, voluntary adoption is not allowed. RBI has deferred applicability for bank. IRDA has deferred the applicability for insurance companies. Okay, check the question. Section 8 company. Section 8 company, are they required to follow Ind AS if their net worth is 250 crores or more? Section 8 company, are they required to follow Ind AS if their net worth is 250 crores or more? Answer is yes. Now, Section 129 of Companies Act says the financial statement shall comply with accounting standards. And accounting standard will also include your Ind AS as well. And there is no exemption. There is no exemption given to Section 8 company from Section 129. And Section 133 talks about the definition of accounting standard. If your net worth is 250 crores or more, to you Ind AS is applicable. The question whether Ind AS applies to Section 8 companies, answer is yes. The auditor is required to ensure the applicable monetary limit. Auditor is required to ensure the applicable monetary limits. Okay, question number 2. Okay, there is a parent P. A is a subsidiary, B is a subsidiary, C is associate or JV of P. C is associate or JV of P. Now, A has a subsidiary X, A has an associate Y, and B has a subsidiary Z. B has a subsidiary Z. Now, out of above structure, only A meets the Ind AS applicability criteria. Okay, A meets the Ind AS applicability criteria. So A meets the criteria. It's applicable to A. If it is applicable to you, it applies to your parent, to your subsidiary, to your associate. If it applies to A, it will apply to P, parent. It will apply to A subsidiary X. It will apply to A's associate JV Y. If it applies to A, it will apply to P, X, Y. Sir, what about this 3? What about this 3 guy? This 3 guy, it will not apply. Roadmap wise, it will not apply, but now pay attention. Roadmap wise, it will not apply. But as P is following Ind AS, they all will be coming under same consolidation. So practically, they will also follow Ind AS. But as per roadmap, it's applicable to A. It is applicable to A's parent, A's subsidiary, A's associate, not parent's other subsidiary, not parent's other associate JV. It's applied to you, your parent, your subsidiary, your associate, your JV. So B, C, Z, to them it as such doesn't apply as per roadmap, but practically they are a part of same consolidation group. They will follow Ind AS. Check the solution. So as parent P will follow Ind AS, so B, C, Z may not follow Ind AS for separate financial statement, but for the purpose of consolidation, they will also need to give the figures as per Ind AS. So practically, they will also follow Ind AS. Okay. Now, how to compute the net worth? You see a net worth as at 31st March 14. Okay, 31st March 14 you see. If you're falling in phase 1, it becomes applicable from 1/4/16. If you're falling in phase 2, it becomes applicable from 1/4/17. But sir, if 31st March 14 my net worth limits are not crossed, check it every year end. Every year end you have to check it, and the year in which you fulfill that net worth criteria, next year say Ind AS is applicable. So one you check on 31st March 14, and every year end you have to check it. The year we fulfill the net worth criteria, next year say Ind AS will be applicable. How to calculate the net worth? It's paid up capital, paid up share capital. Now paid up share capital will include your equity and both. See, you're following AS currently. You will switch over to Ind AS. So paid up share capital is equity plus preference both. All your reserves created out of profit, securities premium, less accumulated losses, deferred expenditure. So simple words mein, don't take revaluation reserve. Don't take revaluation reserve. Okay, the capital reserve is included. Revaluation reserve is not included. Revaluation reserve is not included. And now, those companies to whom Ind AS is applicable, there's a separate format under Schedule 3. Schedule 3 is divided in 3 divisions. Division 1 applicable for companies following AS. Division 2 applicable for companies following Ind AS. Division 3 applicable for NBFCs which are following Ind AS. Then this was your introduction to Ind AS. Going to Chapter 5, Unit 2, Share-Based Payment, Ind AS 102. Okay, this was just an intro. Now going to Ind AS 102. We're required to do two things today. We have a session, this one till 8 p.m. and next we have 9 to 10:30. We have to finish Ind AS 102 share-based payment and Ind AS 103 business combination. Chalo, give me a high five, all of you. Give me a thumbs up or a high five and we move ahead to Ind AS 102. Okay, now chapter number 5, unit number 2, Ind AS 102, share-based payment. Keep your books open. This material, if you want, it's there in our Google Drive link, which is there on our Telegram channel. And this is a part of revision material. We'll not be discussing all questions. Few selected questions I have covered over here. Now, we know that many times company gives share-based payment, or simple words, may ESOPs are given to their employees. And many times to the suppliers, they also give payment by shares. It's not that we pay only to employees by share, ESOPs. We also might be giving shares in other transaction also. Okay, you grant shares or share-based payment or share options to employees and other party. How to account for this all things? Okay, if Ind AS is applicable, accounting will be as per Ind AS 102. If Ind AS is not applicable, we don't have an accounting standard for it, then accounting is done as per guidance note issued by ICAI. Now, going to the word share-based payment arrangement. What do you mean by word share-based payment arrangement? It's an agreement between an entity. It's an agreement between an entity and another party. Agreement between entity, another party, which entitles another party to receive. Cash or other assets of entity. The amount is based on the price of equity instrument. So it's an agreement between entity, other entity, where another party is entitled to receive. If the cash is based on the price of shares of the company or the group entity, or they are entitled not for cash but for the equity instruments of the entity or group entity. Okay, the simple words, the other party is entitled to receive shares of the entity or the group entity, or the other party is entitled to receive cash or other asset, but the amount will depend on the share price of the entity or other entity. Okay, provided certain vesting conditions are fulfilled, and the group entity includes your parent and subsidiary. Group entity is nothing but parent and subsidiary. Group entity does not include associates and JV. Okay, this was share-based payment arrangement. The simple words, if we are paying by giving equity shares or options, that is equity instruments, it is covered here. Or if I'm going to give you cash but which is based on price of shares, that is also covered. Now, share-based payment transaction. It's a transaction wherein you receive goods or services, or your group entity receives goods or services. You receive goods or services, or your group entity receives goods or services, and you have to make payment either by giving shares or by giving cash. But the amount will depend on price of shares. Either you receive the goods or services, or you incur an obligation to settle where your another group entity receives goods or services. Okay? Now let's understand the definition. They say it's an agreement. There has to be an agreement between entity and the another entity or another party. If there is no agreement, there is no share-based payment arrangement. So agreement should be there. It should be communicated, terms are accepted, then only there is agreement. Second, I'll be getting goods or services. I am getting goods or services, or my group entity is getting goods or services, and we are paying by shares or by cash, which is based on price of shares. So goods and services are coming in, we are issuing shares. Now fair value of goods or services coming in and the fair value of shares which are issued may be different. If it is different, assume there is some unidentified goods or services received. There's an example, if shares are given as charity. The fair value of goods or services received may be more or less than the fair value of shares issued. In that case, you assume there's some unidentified goods or services which have been received. still 102 will be applicable. Okay, what is not covered under 102? Transaction with shareholder in capacity as shareholder. Sir, ये क्या है? Transaction with shareholder in capacity as shareholder. For example, we come out with a right issue. We are going to issue shares to the existing shareholder. We are going to issue shares to the existing shareholder. That is not covered under 102. That is not covered under 102. We are not getting goods or services. Cash is not goods. That is not goods or services. Second, shares which we issue under business combination. Shares, if I issue under business combination, I acquire your business, I'm going to give you shares. That's not covered under 102. But under 102, imagine your employee had your ESOPs. I take over your company and I give them my ESOPs. Your employee had your ESOPs, I take over your company and now I convert your ESOPs into my ESOPs. That's covered under 102, but that accounting will learn under business combination chapter. So shares issued under business combination, they are not covered. And third, contract to buy or sell non-financial item. Sir, examples of non-financial item. What are the examples of non-financial item? Inventory, PPE. So contract to buy or sell non-financial item which are entered for settling in net amount. Which are entered for settling in net amount. Net amount में settle होगा, cash में settle होगा. That is basically a kind of speculation. This is covered under Ind AS 109. So contract to buy or sell non-financial asset. Now pay attention. If we enter into a contract, you will give me 1000 kg goods. I'll give you this many shares. You will give me 1000 kg goods. I'll give you this many shares. That's covered under 102. But intention is not to take delivery. You have to give me 1000 kg goods. I have to give you this many shares. If price of goods go up, you give me the net difference in cash. If price of shares go up, I'll give you the net difference in cash. If such type of transaction is there, intention is not to take delivery, then it will fall under 109 financial instruments. It's for speculation purpose. Okay. Now, how to record or when to record the transaction which is a share-based payment? When? So, entity shall recognize goods or services acquired or received in a share-based payment transaction when it receives the goods or services. When you receive the goods or services, we'll pass an entry. When you receive the goods or services, it will be recorded. Okay, suppose I receive goods today. So purchase debit, or if it's a PPE, so PPE debit. Okay, two. I have to give you shares or I have to give you cash based on price of shares. Okay, if I'm going to give you a shares, if it's basically a shares, I'll credit it to equity. If it's a equity settled share-based payment transaction, I'll credit equity. If it's a cash settled share-based payment transaction, I'll credit liability. Okay, if it's equity settled, I'll credit equity. If it is cash settled, I'll credit liability. Now, very important, sir. What do we mean by the word equity settled share-based payment transaction? Equity settled share-based payment transaction is, pay attention. One, if you are going to give your shares, if you are going to give your equity shares, if I'm going to give my equity shares, it's equity settled, or I do not have an obligation to settle. I don't have an obligation to settle. It is possible my parent or my subsidiary is going to pay. So pay attention. What is a equity settled share-based payment transaction? You receive goods or services as consideration for its own equity instrument. I'll give my own equity shares. Or I have no obligation to settle. For example, I purchase the goods. My subsidiary is going to pay cash. I repeat, my subsidiary is going to pay cash based on price of shares. I purchase goods, my subsidiary will pay. For me, it is equity settled. Sir, why for me it is equity settled? I do not have an obligation to settle. So either you are giving your own equity shares or you do not have an obligation to settle. That is basically equity settled. Okay. If it's a equity settled, we credit equity. If it's a liability, if it's a cash settled, we credit liability. Now, if it's equity settled, If it's equity settled, we'll credit the equity. If it's liability settled, cash settled, we credit the liability. Now question arises, sir, what amount? What amount? So amount should be, if it's equity settled, if it is equity settled, amount should be the fair value of goods or services. We're getting goods or services, we have to give shares, our shares, or we don't have obligation to settle. Amount will be basically your what? Amount will be equal to the fair value of goods or services which we receive. Fair value of goods or services which we receive. Okay, unless that cannot be estimated reliably, if that cannot be estimated reliably, then we take the fair value of shares which are to be issued. Then we take the fair value of shares which are to be issued. Okay, I repeat again, what is equity settled? Either you are going to give your own equity shares or you don't have an obligation to settle. I purchase goods, my subsidiary is going to settle it. Subsidiary will give their shares or they are going to give cash based on price of shares. For me, subsidiary is going to give shares. I don't have an obligation to settle. For me, it is equity settled only. Okay. And whenever it's equity settled, the transaction will be recognized at fair value of goods or services which are received. If fair value of goods or services received cannot be estimated reliably, then we take the fair value of shares which are to be issued. For cash settled, you should measure the goods or services acquired and the liability incurred at the fair value of liability. Now one thing, if it's cash settled, if it's a liability, you need to remeasure the liability every year end. If it's a liability, it will be remeasured. If it's an equity, it will not be remeasured. Next is the grant date. Next is the grant date. What do you mean by grant date? Grant date is the date at which the entity and the other party agree to a share-based payment arrangement. When you entered into that share-based payment arrangement, that's called as a grant date. Okay, not relevant much. Now, employee share-based payment. Your employee share-based payment, there are three types: ESOPs, ESPP, and SAR. ESOPs. Under ESOPs, the employees are entitled to get a fixed number of shares in future at a fixed amount. So fixed number of shares I'm going to give them in future at a specified price. So they have a right, yeah, option hai na? It's a right to purchase shares in future at a specified price, but I'm not giving shares today, I'm going to give them shares in future. And it's a right to them. They may take it, they may not take it. Under ESPP, the shares are issued now only. The shares are issued now only at a discounted price, either as a part of public offer or otherwise. So their shares are issued now only. Under SAR, we are not going to give them shares. They are entitled to get in future based on price of share. They are entitled to get cash based on price of shares in future. Mein. So here it's not shares to be given. Here the cash will be given over and above the exercise price. If I say that you are entitled to anything over and above 150 ke upar, whatever the price is, I'll give you that much in cash. Above 150, whatever the price is, that much I'll give you in cash. That's SAR. ESOPs may, we are going to give them shares in future. SAR may, we are going to give them cash in future, but based on price of shares. And ESPP may, the shares are issued now only at a discounted rate, either as a part of public issue or otherwise. I hope this is clear. Now, accounting for ESOP. We are going to give them shares in future. So today the options are granted. Vesting period is 3 years. Shares are to be given after 3 years. Now, today the price is 50 rupees. Today the price is 50 rupees and I said I'll give you after 3 years at 20. So as per today's data, it seems there's a benefit of 30. Market price 50, I'm going to give them at 20. This is today. This is called intrinsic value of option on grant date. This is called intrinsic value of option on grant date. Now, this is not the actual benefit to employee. Actual benefit to employee will be what will be the market price when they exercise after 3 years. After 3 years get over, they will exercise. After 3 years, when they exercise, what will be the market price? And I'm going to give them at 20. That is the actual benefit to employee. Now, actual benefit to employee is the actual loss to us. We are giving them a discounted rate. We are not charging the actual amount. Whatever is actual benefit to employee will be the actual loss. But now the thing is, ESOPs are given to retain the employees over the vesting period. ESOPs are given to retain the employee over vesting period. Vesting period was 3 years. ESOP expense. The ESOP expense should be recognized over a period of 3 years. Actual expense will be known after the 3 years are over. Actual expense will be known after 3 years are over. So, sir, how do we account for ESOP expense? Intrinsic value of option or fair value of option is recognized as an expense over the vesting period. I told you market price today 50, today the rate is I'm going to give you at 20. This 30 is intrinsic value on grant date. This is intrinsic value on which date? Grant date. Intrinsic value of option or fair value of option. Now, sir, how to find fair value of an option? There are experts available for that. So, question will always give you the fair value of an option. Normally, layman ki term mein, if I want to say, what will be the market price in future? Estimated. And I'm going to give you a 20 rupee. What will be the market price in future? And I'm going to give you a 20 rupee. That difference is actually the fair value of an option, but that's in layman's term. So many other parameters are involved. We don't have to find out the fair value. It's always given in question. The intrinsic value of an option or fair value of an option, this is recognized as an expense over the vesting period. Now, Ind AS does not allow intrinsic value of an option. Ind AS allows only fair value of an option. It's a fair value of an option. It's not fair value of share. Right जो आपको दिया, the right which you got, what is the fair value of the right? That's fair value of an option. So, fair value of an option will be recognized as an expense over the life of ESOP. So, over the vesting period, it will be recognized. Now, sir, how do I recognize it? Do I recognize it evenly? Like suppose fair value of an option given in question is 50 rupees. I have to recognize 50 rupee over 3 years. Do I book it evenly? Now, pay attention. First of all, expense which we are required to book should be based on the latest information and the latest estimate available. So expense will be based on how many number of employees are expected to fulfill the vesting condition. I repeat, expense will be based on how many number of employees are expected to fulfill the vesting condition. So it is possible first year may we thought, there are 3 years, right? First year 10 employee left. Now we'll think how many will leave in second and third, and we'll estimate some figure who are expected to fulfill the vesting condition. The first year actually 10 left, second and third we estimated 30 more will leave, and then we find out some figure. But when I come to second year, can I say what I estimated in first and what actually left in second may be different? The number of employees expected to fulfill the vesting condition keeps on changing. Your total estimated expense keeps on changing. And as your total estimated expense keeps on changing, the amount cannot be even. How to find out the expense to be booked? How to find out the expense to be booked every year? Expense to be booked every year will be expense to be booked till date minus the expense already booked in prior period. Expense to be booked till date minus the expense already booked till prior period. Okay, and I told you again, Ind AS 102 does not allow intrinsic value of an option. You mandatory need to use fair value of an option. And our fair value of option is determined on grant date. Fair value of an option is determined on grant date. If it is equity settled, the fair value is not revised. If it is equity settled, the fair value is not revised. But if it is cash settled, the fair value we re-estimate every year. If it is cash settled, the fair value will be re-estimated every year, and we will be taking the latest fair value if it is cash settled. Equity settlement, the fair value is not revised. The one which is estimated on grant date, we continue that only. An expense is based on latest information, latest estimates, and it's based on the number of employees expected to fulfill the vesting conditions. Okay, now journal entry. Day 1, when I grant the ESOPs, no entry. Day 1, when we grant the ESOPs, no entry. First year end, I have to book expense. First year end of book expense, so employee benefit expense 2. If I have to give them the shares, it's SBPR, share-based payment reserve. If I have to give them cash, it's SBPL, share-based payment liability. So employee benefit expense to SBPR, employee benefit expense every year goes to P&L. ICI doesn't pass this entry, going to P&L wala, practically you may have it. Okay, this SBPR which you credited, it will remain. It will remain. At the end of vesting period, if the options are exercised, the balance of SBPR will get converted into equity share capital or securities premium. But at the end of vesting period, if the options are not exercised, the balance of SBPR will be transferred to retained earnings. Okay, SBPR will continue in your balance sheet under your other equity. SBPR will continue in your balance sheet under other equity till the options are exercised or unexercised at end. If they are exercised, it gets converted into equity share capital or securities premium. If they are not exercised, it will be transferred to retained earnings. Now, when the options are exercised later, I'll get the exercise price bank debit. And I booked the expense was lying in SBPR. Expense debit to SBPR. The SBPR now goes away and equity share capital securities premium comes in. Now pay attention. If it is equity settled, the fair value of option which was estimated on grant date is not changed. And we have booked some expense based on the fair value of option on grant date. Imagine fair value of option on grant date suppose was 50 and we are getting 20 rupees. So 20 we got, 50 we have booked expense. Assume your shares are issued at 70. 20 we got bank debit. 50 is there in SBPR debit. Shares are issued at 70. Market going on today. Actual market price going on today is of no use. Actual market price going on today is of no use. And sir, for wasted option getting lapsed, now there are two words: wasted option getting lapsed, unwasted option getting lapsed. What is wasted option, unwasted option? Unwasted option means the wasting period is not yet over. Imagine employee leaves in between. Wasting period is not yet over, employee leaves in between. That's called as unwasted option getting lapsed. There's no entry required specifically for unwasted option getting lapsed. Its effect will automatically come while booking subsequent expense. If some employee leaves, number of employees expected to fulfill wasting condition will reduce. So automatically their effect will come. Unwasted option getting lapsed, no entry. Okay, for wasted option getting lapsed. For the wasted options which are getting lapsed, employees were there for 3 years, expenses booked, they don't take the shares. They don't exercise. Expenses already booked, they're not exercising, reverse it. We need to transfer it to retained earnings. Okay, sir, expense was lying where? SBPR. So SBPR may say remove it, take it in retained earnings. I hope this is clear. Okay, let's move on to types of condition. Let's move on to types of condition. This is important. Keep replying. Beach may keep on replying. Whatever small things I asked, I put a pause over there. You should keep on replying. The more you are active, more you'll enjoy the sessions. Okay, types of condition. Now there are two types of condition. One is called wasting, other is called non-wasting. Wasting, non-wasting, both are to be fulfilled to be entitled for share-based payment. Both. Wasting also, non-wasting also, the other party has to fulfill both. Now wasting conditions are divided in two parts. Vesting conditions are divided in two parts, service and performance. Service is you have to stay for this many years. You have to stay for this many years. That's called as a service condition. Second, performance. Performance condition can be two type, market related based on share price. Share price reaching this much, that's market related. Non-market related is internal performance, profit reaching this much, production reaching this much, that's internal performance. Now what is not in your hand is the share price. What is not in your hand is the share price. Now see, nobody knows when the price will reach this much. Suppose they say that you are entitled to get the ESOPs when the share price becomes 100. When the share price becomes 100, nobody knows it. In spite of you doing well, share price may not go up. Market conditions are not good. Or in spite of not doing well, the share price may go up because markets are speculative. They're doing very well as of now. So if it's a market related condition, you are entitled for ESOP whenever market price becomes 100. Now when will market price become 100? I don't know. I estimate on grant date. If it's a market related condition, share price reaching 100, will estimate the vesting period on grant date, and the estimate of the vesting period will not be revised over the vesting period. Usko change nahi karenge. Yaar, you don't know, why speculate? But if it's based on internal performance, non-market related, profit reaching 100 crores. Okay, the initially will estimate on grant date when the profit will be 100 crores. Every year end, we will reassess it. We'll reassess it and revise it if necessary. So market related condition hai, we are not going to revise the estimate of vesting period done on grant date. Non-market related, based on internal performance, we are going to review and revise the vesting period estimated on grant date. The vesting condition can be two types, service, performance. Performance can be again two types, that is market related, non-market related. I hope you're clear. Acha, one more thing. Under performance condition, the service condition is always linked. Like when market price becomes 100, but you have to stay with us till that price become 100. Under performance condition, the service condition is always linked. If in performance condition, service condition is not linked. If in performance condition, service condition is not linked, like you have to stay for 2 years, you can leave. After leaving also, whenever price will become 100, you are entitled for ESOP. Even though you left, if service condition is not linked, then it's called as non-vesting condition. Okay, then normally for performance condition, the service condition is linked. If service condition is not linked, then it will be called as non-vesting condition. Now impact, pay attention. Few conditions we consider while determining the fair value of option on grant date. The expert will consider, and few conditions will consider in order to decide the vesting period, in order to decide whether the options will vest or not. Okay, the service condition, whether employee will fulfill 3 years service. So this is used to determine number of employees expected to fulfill vesting condition. This is used to find out number of employees expected to fulfill vesting condition. So whether they will fulfill the vesting condition, whether they will be there for 3 years, तो वहां पे यूज होता है. Performance condition which is market related. I told you market related है. When price will become 100, we estimate vesting period on grant date. We don't change it now. They say that if market price becomes 100 rupee in 5 years, now it is possible market price may not become 100 in 5 years. So impact of this market related performance condition is taken by the expert while determining the fair value of an option. We don't have to check it every year. But a performance condition which is non-market related, internal hai. So whenever the profit reaches 100 crore, so we check every year, and this will impact your vesting period. The first year we thought it will waste after 5 years. Now we are doing very well. Now we feel vesting period will not be 5 years, vesting period will be 3 years. It will be checked every year. The service condition impacts number of options expected to waste. Performance condition non-market related. Non-market related will affect the wasting period. Market related and non-wasting condition, their effect is considered while determining the fair value of an option. So it is possible that condition might not be fulfilled. Uski probabilities are considered in fair value of option. They are not checked every year. Now, variation in wasting period. Variation in wasting period. This can be due to performance condition which is a non-market related. Okay, performance condition which is non-market related. Whenever profit becomes 100 crore. Initially we thought profit will become 100 crore after 5 years. But now after 2 years we felt we are doing very well, we'll reach 100 crore in next year only. Though initially we thought wasting period is 5 years, now the wasting period is changed to 3 years. So it is possible there is a variation in wasting period, but it's only due to non-market related performance condition. If it's a market related performance condition, estimated wasting period estimated on grant date is not remeasured. Now I have a question for you. Imagine it's a performance condition market related. It's a performance condition market related. Share price reaching 100 rupees. Whenever share price will be 100, options will be wasted. Initially we thought wasting period 5 years. Do we reassess it? Share price reaching 100. Initially we thought wasting period will be 5 years. Do we reassess it? No, correct. We don't reassess. Now suppose in 4th year the price became 100. Book the remaining expense in 4th year itself. You have booked in 1st, 2nd, 3rd. Full remaining expense, book it in 4th year also. If price becomes 100 in 4th year only. Okay, suppose price becomes 100 in 7th year. We had taken a wasting period of 5 years. Book expense over 5 years. Now, options are not lapsed. Continue SBPR. 6th year, don't book any expense. 7th year, SBPR gets converted into equity share capital. As the price has reached 100, options will be exercised. So if the price becomes 100 in 4th year only, remaining expense will be booked in 4th year. If the price becomes 100 in 7th year, expense is booked only in 5 years. But options are not lapsed. Continue SBPR. If options are not lapsed. 6th year, no expense. 7th year, they will be converted into equity share capital. Okay. Now, we have a question number 1. This is based on variation in wasting period. Now, they are telling wasting period will be 1 year if earning increases by 12%. Wasting period will be 2 years if earning increases by more than 20% over 2 years. And it will be 3 years if earning increases more than 22% over 3 years. Okay. Now, earning in first year is 10. Oh, it's not 12. I understand wasting period is not 1 year. See, we are in first year. We understood wasting period is not 1 year. It can be 2 years, it can be 3 years. Now, when you are in first year, you don't know the profits of second and third year. It will be based on estimate. Now, the company expects that earning will continue at similar rate in 2002. Next year also will earn 10. 10 plus 10. So 20. Now, actually, it should not be more than 20. It's 20 or more. There's a typing mistake in question. So 20 or more. First year we earn 10%. Wasting period is not 1 year. Now, it may be 2. It may be 3. First year we earn 10. Expectation is again will earn 10. Total in 2 year will be 20. Oh, is it making 20? Yeah. When I'm in first year, the total wasting period we are taking is, the total wasting period estimated is 2 years. Because it becomes 20. But when I actually come to second year, I understand it's not becoming 20 and then my wasting period is changed to 3 years. So when I was in first year, the total wasting period estimated is 2 years. When I come to second year, the total wasting period is changed to 3 years. Did you understood this? Okay, next question. This is the question which we discussed. Now, there's a market condition. There's a market condition. What's the market condition? Share price reaching 30. Share price reaching 30. Now, when share price will reach 30, nobody knows. So, expected wasting period is 4 years. Expected wasting period is 4 years. Okay, would we remeasure it? Would we remeasure this 4 years every year? No, this is based on market condition. So, performance condition which is based on market one, they are not to be remeasured. So, expected wasting period 4 years, will book expense over 4 years. Now they are telling, suppose you reach the price in 3 years only. Suppose if you reach the price in 3 years only, first, second, maybe you book the expense, third may book the full remaining expense. But if you reach the price in 5th year, if you reach the price in which year? 5th year. So what I do? You book expense only in first 4. Book expense only in first 4. Don't book any expense in 5th year. But in 5th year, the balance of SBPR will get converted into equity share capital. After 4 years, options had not lapsed. Expected wasting period was 4 years. We book expense in 4 years. We don't remeasure it under market related performance condition. We don't remeasure it under market related performance condition. So we book expense in 4 year, 5th year mein expense is nil. But 5th year the SBPR will get converted into equity share capital. Is it clear? This was question number 2. Let's go to the next point, which is modifications to ESOP. Now, an entity might modify the terms of ESOP. SEBI does not allow, I repeat, SEBI does not allow any modification which is against the interest of company, against the interest of employees. But SEBI is only for listed entities. If it's unlisted, net worth 250 crore or more, Ind AS applies. SEBI doesn't apply. So modification may be there. Now, because you modify the term, employees have an option with them. ESOPs, they have an option. Because you modified the term, the fair value of option may go up or down. Because you modified the term, the fair value of option may go up or down. Suppose, pay attention, suppose if you increase the exercise price, the benefit to employee will go down, the fair value of option will go down. If you increase exercise price, fair value of option goes down. If you decrease the exercise price, oh, benefit to employee increased, the fair value of option will go up. So depending on changes in term, the fair value of option may go up or down. If the fair value of option is going down, ignore it. If the fair value of option is going down, ignore it. Continue as per original expense what you are booking. But if the fair value of option is going up, the additional expense will be recognized. I repeat, the additional or incremental expense will be recognized over the remaining wasting period. Okay, if modification increases the fair value of award, you must record the additional cost. The additional cost is spread over the period from modification date till the date the modified options are going to waste. Simple words mein, it's over the remaining period. So from date of modification to the date the options are going to waste, that period may you record the additional cost. Now see the word additional cost. If there's a modification, pay attention, if there's a modification, the original expense which you're booking, the original fair value of an option which you are booking, that will continue as it is. The original fair value of an option which you are booking, that will continue as it is. The additional cost arising due to modification, that is to be amortized over the remaining wasting period. Now, how to find out the additional cost due to modification? How to find out the additional cost due to modification? Fair value of modified option, the new one. The fair value of modified option on the date of modification minus the fair value of original option on the date of modification. The fair value of modified option today minus the fair value of original option today. Now pay attention. Under equity settled, the fair value of option estimated on grant date is generally not remeasured. But if there's a modification, the fair value of option estimated on grant date, we will remeasure it today. So today वो option का value कितना था? What is the fair value of option which you're holding? Uska value today. And new option, the modified option, what is the value of that? Difference is incremental or additional cost. I repeat, under modification, the original cost which you're booking, the original cost that was the fair value of option on grant date which you're booking, that will continue as it is. Additional cost will be booked over the remaining vesting period. Sir, how do I find the additional cost? How to find additional cost? Fair value of modified option today minus the fair value of original option today. That is to be considered. And this will be spread over the remaining vesting period. Let's check question number 3. Let's check question number 3. Marathon Inc. had issued 150 share options and the fair value of option was 129. This is the fair value of option on grant date. Okay, do we remeasure it? Answer is no. But if there is a modification, we'll find out the fair value of original option on date of modification, compare with the modified option. Otherwise, this is not remeasured. This 129 will be booked over a period of 3 years. 129 will be booked. Original expense remains as it is. Additional expense will be booked over the remaining vesting period. Now, year 1, you have 35 employees left, 60 are expected to leave. Now, the market price have fallen. Market price have fallen, and that's why you decided to change the terms of an option. The fair value of option today has fell to 50. Okay, the day when I granted you option, the fair value was 129. This is fair value of option, not the shares. The day when I granted you option, the fair value of option was 129. Today, what is the fair value of original option today? 50 rupees. What is the fair value of original option today? 50 rupees. After repricing, I changed the terms. Now the fair value is 80. Now they are worth 80. So you have an option which are worth 50 today. I am modifying the term. Now they are worth 80 today. You have an option which are worth 50 today. I am modifying the terms and now they are worth 80 today. I gave you extra additional benefit of 30. And this repricing is done at the end of year 1. What's the remaining vesting period? Next 2 years. This 30 rupee will be booked over the next 2 years. If I ask you a question, would we continue the original 129 expense over 3 years? Would we continue the original 129 rupee expense over 3 years? Yes, this will be continued. Additional 30 rupee will be booked over the next 2 years, second and third year. First year end they are repriced. They are modified from today onwards till the vesting period gets over. Next 2 years may have to book it. So original 129 you will continue and you will book the 30 rupee in second and third year. So it's first year and they are repriced. Over the next 2 years it will be booked. In total we are booking expense 129 plus 30. In total we are booking expense 129 plus 30. That is the expense which we have booked. Okay, this is modification. Now going to cash settled. Okay, stock appreciation right. Under cash settled, we are not going to give you shares. We are going to give you cash only. We are going to give you cash based on price of shares. So whatever is the price above 150 on exercise date. Whatever is the price above 150 on exercise date, I'll give you that much cash. So in simple words, pay attention. I will give you intrinsic value of option on the date of exercise. In simple words, I am going to give you intrinsic value of option on the date of exercise. When you are exercising, What's the market price and what's the exercise price? The difference I'm giving you in cash, but it's intrinsic value of option on exercise date, not grant date. So day one, how much cash I need to pay you, I don't know. So day one, the fair value of option is estimated. The fair value of option on grant date is found out, and as it is cash settled, we will remeasure it every year. See, it's a liability. We need to bring it to the current value. It's a liability. You need to bring it to the current value. So, sir, how do we account for SAR? How do we account for SAR? Accounting for SAR is same as ESOPs. Accounting for SAR is same as ESOP. It's based on number of employees expected to fulfill wasting condition. Number of employees expected to fulfill the wasting condition into your basically the fair value of option. You get the total estimated expense and the total wasting period, expense to be booked till date minus already booked, we get current year. It's same, but only thing is the fair value of SAR is remeasured every year. If you just recall the sums which we solved, we had number of employee expected to fulfill the wasting condition. उसके बाद that was number of employees expected to fulfill wasting condition, number of option, the total number of option expected to waste into fair value. If it's equity settled, the fair value of an option all years remain same. If it is cash settled, the fair value of option is remeasured every year. First year end, second year end, third year end, they're all remeasured. The total estimated expense accordingly will change. The fair value of SAR will be remeasured, and instead of SBPR, we'll call it as SBPL. Instead of SBPR, we'll call it as SBPL, share-based payment liability. And at the end, the intrinsic value of option on exercise date. Exercise date, what is the market rate going on? And I have to pay over and above how much? That is paid in cash. Now, it's possible, pay attention. We booked expense, fair value is revised, first year end, second year end, third year end. Now we have some expense, we have some liability in books. Now pay attention. Suppose they exercised after 1 month. The liability in books is something, we are paying something else. That difference will go to P&L in fourth year. I hope this is clear. Now, check question over here. Now, there was a question wherein there is a very interesting word written, that waste immediately. They've written that waste immediately. If it waste immediately, the full expense should be recognized day one. Full expense should be recognized on day one, and then if the fair value changes, we need to bring it to the current value. Liability is to be brought to current value if the fair value changes. If it waste immediately, book it fully on day one. So 10,000 SAR, fair value on day one is 95. The book 10,000 into 95 immediately on day one. 9,50,000 is expense recognized on grant date. 950 is expense recognized on grant date. Now, they say that it is expected 95% will exercise, then we think 92% will exercise, and eventually 89 exercised. The first year end, now we think 95% will exercise, and now the fair value is 112. Okay, so now 95% and fair value 112, total estimated expense is now 1064. Earlier total estimated expense was 950, now it's 1064. We have already booked because it waste immediately. Now change, you book it now. I suppose you're clear with this question. The word waste immediately was important. Okay, next question, question number 5. Question number 5. We have 400 SARs given to 75 employees. Grant date, the fair value is 200. Okay, do we need to book any expense on grant date? They don't waste immediately. They say they will provide service over 4 years. This question, it doesn't waste immediately. Last question, it was wasting immediately. So we book full expense on day one. Here, nothing to be booked on day one. Now, first year end. First year end, we will be booking the expense, but are not based on 200, it will be based on 210. It's SAR, fair value is remeasured. Fair value is remeasured. Total estimated expense, you have to book 1/4. You have to book 1/4 till date, already booked is nil. First year end, 1/4 to be booked, already booked nil. Second year end, 2/4 to be booked, already booked, we deduct. Third year end, 3/4 to be booked, already booked, we deduct. Fourth year end, full should be booked, already booked is deduct. Last question, word was waste immediately. This question, that word is missing. So don't book full expense on day one. Okay. Now, what would your answer be different if at the end of second year of service, if at the end of second year of service, you modify the term to require not 4 years, you modify the term to require not 4 years, but to require only 3 years. You modify the term to require not 4 years, you modify the term to require 3 years. Now, this is not going to change the fair value of an option. So this modification doesn't affect fair value of an option, so don't treat it as modification. They've not given the additional incremental cost of modification. It's not there. Treat it as variation in vesting period. Don't treat it as modification. Reason, if it's a modification, we need increase in fair value, etc. वो सब नहीं है यहाँ पे. So if suppose in second year the vesting period from 4 years is reduced to 3 years, so what to do? First year when we were booking expense, vesting period was 4, total vesting period. Second year mein, okay, end mein I know na, the total vesting period don't take 4, take 3 years. Third year it is 3 years only. When you are in second year, the total vesting period should be taken as not 4, but total vesting period should be taken as 3. I hope you're clear with this. Question number 5. Okay, question number 6, RTP May 2020. Question number 6, RTP May 2020. One request to all of you, please make sure that you do the material which you have referred. Like suppose our class material. If you've done some other faculty's class, whatever faculty you've done, refer that faculty's material plus last 3 RTPs. Last 3 RTPs, last 3 suggested answers you should go through. That's very important. Now, question number 6, pay attention. This is again of SAR. Question number 6 again is of SAR. We have given to 40 employees and they're entitled for a cash, and it can be exercised during, now exercise during 2007, 2008. Okay, I can exercise in 2007 also, I can exercise in 2008 also. Okay. And we estimate 10% employee will leave during the 2 years, and actually 10% left. We estimated 10% will leave, 10% left. Okay. There were total 40 employees, 1000 SARs. 40 employees, 1000 SARs. So we are not going to book expense for 40, 10% are expected to leave 36. 36 employees into 12, 36,000 into 12, 36 employee, 1000 of SAR into 12. Total estimated expense, vesting period is 2 years. So I'll book half. Next year it's 36 into 1000 into 8. I have to book full, already booked with deduct. Now pay attention. So this was vesting period, this two are exercise period. This two are vesting period, last two are exercise period. Next, on 31st December 7, when intrinsic value was 10, 6 employee exercised. Okay, pay attention. 31st December 7, when intrinsic value was 10. Now you will say, sir, yahan pe 13 diya hai fair value. Leave that. Leave that. Don't think this way. It is possible morning of December 31st and evening of December 31st, rates are different. Morning of December 31st, evening of 31st December, rates are different. Now, we have booked expense 8 rupee. We have booked expense 8 rupee. Now, 6 employees exercised when intrinsic value was 10. So 6 employees into 1000, we already booked 8. We have to make it 10, 2 rupee you book it. 6 employees into 1000, 2 rupee extra you book it. Now they've exercised, they will be paid. Remaining 30 employee, bring them to closing rate. Okay, so 10% had left, 40 में से 4 gone. So how much were there? 36. 40 में से basically they are gone. Now we have 36. Out of 36, 6 exercise, 30 are still pending. 6 exercise, the rate was 10. Book may we already booked 8. 2 rupee you book for them in third year. And for that 30, we have booked 8. I have to bring it to 13. We have booked 8. We have to bring it to 13. 5 rupee you booked. So for 6,000 you book 2 rupee. For 30,000 you book 5 rupee. Now for 30,000 we have this 13 rupees in our book. What happened next year? Next year 30 employees exercise when the intrinsic value was 12. 30 employees exercise when intrinsic value was 12. In our book 13 is booked. 8 tha plus we booked 5. 1 you reverse it for them. 1 you reverse it for them, and now 12 rupees booked for the 30 employee and we pay them. Okay, so very important, pay attention here. Few employees exercise in 07, few employees exercise in 08. So out of 36 employees, 6 employees exercise in 07. When they exercise, the intrinsic value was 10. I have to pay them 10. 8 was booked, 2 we book for them extra, and the 10 is paid to them. For remaining 30 employees, 8 was booked, bring it to 13 closing rate. So now for that 30 employees, 13 rupees is booked. Now that 30 employee exercise when that intrinsic value was 12, to 13 we have booked, 1 you reverse, and then that 12 is paid to them. I hope you are clear with this question. Question 6. I hope you are clear with this question. Question number 6. Now, share-based payment with cash alternative. Cash alternative. They can go for shares, they can go for cash. Now, whether they will go for shares, whether they will go for cash, I don't know. I don't read their mind. If it is at counterparty's choice, opposite party, counterparty as an option, whether they will go for shares, whether they will go for cash, I don't know. Sir, what do I do? What do I do? Okay, so estimate on grant date. Estimate on grant date. If everybody goes for shares, what is the amount payable? And if everybody goes for cash, what's the amount payable? Generally, if they go for shares, I'll give them more number of shares. This is to make them go for shares. If you want cash, it's for 10,000 shares. If you want shares, it's for 12,000 shares. Okay, so pay attention. So first, what you need to do, if such alternatives are given to employee has a choice of settlement, whether he'll go for shares, whether he'll go for cash. If he has a choice of settlement, first you measure on grant date, assuming all employee go for cash settlement, all employee go for equity settlement. If I ask you where the total amount will be more, the fair value under cash settlement will be more, or the fair value under equity settlement will be more? It will be under equity settlement more. Reason, equity settlement, not giving them 10,000 shares, I'm going to give them 12. If you go for cash, 10,000 shares pay. If you go for shares, for 12,000. If everybody goes for cash, what's the fair value on grant date under cash settlement? If everybody goes for shares, what's the fair value? What's the fair value of option under equity settlement? Now, whatever is coming under cash settlement, treat that as SAR. And whatever extra is coming under equity settlement, suppose this came up 3 lakh under cash settlement, fair value of option, and under equity settlement, suppose it's coming 324. Under cash settlement it's 3 lakh, under equity settlement is 324. So 3 lakh will be treated as SAR, SBPL ki tarah accounting, and extra 24 under equity settlement, that will be accounted as per ESOPs. Okay, the fair value under cash settlement will be the liability component. Excess fair value under equity settlement will be treated as an equity component. Okay, so the plan is divided in 2 parts. I don't know whether they'll go for shares, whether they'll go for cash. I found out the fair value of option on grant date, assuming everybody goes for cash, assuming everybody goes for equity. So whatever is coming under cash settlement, that's called as liability component. Extra coming under equity settlement is called equity component. Liability component will be accounted as if SAR, equity component will be accounted as ESOP. So we have accounted wo 3 lakh wala part as SAR. It will be remeasured. Extra 24 was equity component. That is booked like ESOP. That's not remeasured. Okay, now suppose afterwards, if they go for cash, the 24,000 booked as ESOP, SBPR, that get reversed. It will go to retained earnings. 24,000. 3 lakh wala remeasured and then paid. If they go for cash. If they go for shares, what to do? If they go for shares, then in that case, the liability component SBPL, remeasure, SBPL is transferred to SBPR, and then the balance of SBPR gets converted into equity share capital. If they go for shares, so SBPL is transferred to SBPR, and then SBPR gets converted into equity share capital. But if they go for cash, the SBPR is transferred to retained earning. SBPL is then paid off. Okay, this is when counterparty has a choice of settlement. I don't know, so part is treated as cash settlement, part is treated as equity settlement. We have a liability component, we have an equity component. Liability component accounted like SAR, equity component accounted like ESOP. Okay. This is if counterparty had a choice of settlement. Now entity has a choice of settlement. I have to decide. If entity has a choice of settlement, whether I want to give shares, whether I want to give cash. See, I know my mind. If in my mind I'm sure I'm not going to add new shareholders. So then I know I have to give cash only, treated fully as SAR. So you account either as cash settled or equity settled, whole award, whole. When counterparty had option, part was equity component, part was liability component. But when you have a choice of settlement, you know what you want to do. So whole award should be either cash settled or whole award should be either equity settled, depending on how you plan to pay. I hope this is clear. Now check this question number 7. Nothing is given, the counterparty has option of settlement. Nothing is given, counterparty has an option of settlement. See, if you go for cash, 74,000 shares I'll give. But if you go for equity shares, I'll give you 90,000 shares. Okay, but if you go for equity shares, that shares after 3 years when you get, you cannot sell it for 2 years. Okay, now this is the fair value. Of option with a restriction to sell for 2 years, and this is the fair value 135. Now if you go for cash, there is no restriction. If you go for shares, I'll give you shares after 3 years, 90,000, but you cannot sell it for next 2 years. Now fair value of a option which has some restriction will always be lower. Fair value of an option which has some restriction will always be lower. If I ask you over here, what will be the liability component? 74,000. If they go for cash, 74,000 into 135. 74,000 into 135, 99,90,000 is liability component. Your liability component is coming 99,90. Okay, what will be the equity component? The excess 90,000 into, should I take 135 or 115? Should I take 135 or 115, sir? 115. It has restriction, the fair value will be lower into 115. So this is coming as 1,03,50,000 minus 99,90. So extra 360 will be coming equity component. 99,90,000, 74,000 into 135. That's your liability component. Equity mein extra 90,000 into 115. 90,000 into 115. This is 103, 1,03,50,000. Excess is 360. That 360 is regarded as equity component. So 9990 is liability component, 360 is equity component. 9990 liability component account like SAR, equity 360 account like ESOPs. Okay, this is done. Cancellation settlement I start after the break. I repeat, the cancellation and settlement wala point I'll be starting after the break. Only this point and one more. If your holding or subsidiary pays for it, that 2 points are pending. Okay, just give me a feedback. Chalo, how was it? This was the first session. We can understand how to improve upon the remaining sessions. Was it fine? Do you think anything extra or less we can do? Give me feedback about this session. How was it? We again have a session today at 9 o'clock, 9 to 10:30. We'll finish off this share-based payment and we'll also finish off business combination. Share-based payment bhi khatam ho jayega, business combination bhi khatam ho jayega. Tomorrow we'll be doing consolidated financial statement. Achha, tomorrow we'll have 5:30 to 8 one session, 8:30 to 10:30 another session. Tomorrow onwards it will be on Unacademy app. You can use code Yeshesh or Yeshesh Live to access the free classes. It's free on Unacademy also. Just use the code Yeshesh or Yeshesh Live to access the free classes. Okay, thank you Devkinandan, thank you Ganesh, thank you Bala, Shankar, thank you Pulkit, thank you. Ganesh, I can understand in your material you have all the questions. Yahan pe only few are there, so you just have to flip the things. That can be a bit difficulty, but no option to it. This material which I have over here, this is also put up on the Google Drive link. If you want, you can take a soft copy, but according to me, better is refer your material only which you are having. No need to take a printout of this at the last moment. Okay, Pulkit has a question, sir. Did you do a fast track batch? Yes, we have a fast track batch. So at Unacademy, I have done a regular batch, I have done a fast track batch, and now we are doing a free revision. Regular batch is around 290 hours, fast track batch is around 120 hours. And this revision is around 25 hours, free for everyone. And if you like it, please share it with all your friends. So after the break, we'll finish up this share-based payment. We are going to start business combination. You can tell your friend if they want to attend business combination. Tomorrow is consolidation and we'll be covering all in days. Yes, all standards, all chapters will be covered in revision. Only thing we'll cover only from the view of examination. Done? Shall we take a break? Chalo, we meet again. We meet again at 9 o'clock, 9 to 10.